Hello everyone, welcome to my channel. This is Easy Accounting channel. Today we are studying IFRS 14, Regulatory Deferral Accounts. Accounting Policy. IFRS 14 provides an exemption from paragraph 11 of IAS 8, Accounting Policies, changes in accounting estimates and errors when an entity determines its accounting policies for regulatory deferral accounts balances. Paragraph 11 of IAS 8 requires an entity to consider the requirements of IFRS dealing with similar matters and the requirements of the conceptual framework when setting its accounting policies. The effect of the exemption is that eligible entities can continue to apply the accounting policies used for regulatory deferral account balances under the basis of accounting used immediately before adopting IFRS. When applying IFRS subject to the presentation requirements of IFRS 14, so entities are permitted to change the accounting policies for regulatory deferral account balances in accordance with IAS 8, but only if the change makes the financial statement more relevant, no less reliable, or more reliable, not less relevant, to the economic decision-making needs of the users of the entity financial statements. However, an entity is not permitted to change accounting policies to start to recognize regulatory deferral account balances. So let's talk about interaction with other standards. The requirements of other IFRS are required to be applied to regulatory deferral account balances, subject to specific exemptions and additional requirements contained in IFRS 14. So let's talk about the financial statement presentation. The impact of regulatory deferral account balances are separate, presented in an entity financial statements. So this requirement applies regardless of the entity previous presentation policy. Number 1, separate line items are presented in the statement of financial position for the total of all regulatory deferral accounts debit balances and all regulatory deferral account credit balances. Number 2, regulatory deferral account balances are not classified between current and non-current, but are separately disclosed using subtotals. Then the net movements in regulatory deferral account balances are separately presented in the statement of the profit and loss account and other comprehensive income using subtotal. Disclosure of IFRS 14. IFRS 14 sets out disclosure objective to allow users to assess the nature of the risk associated with the IFRS 14, the rates regulation that established the price the entity can charge customer for the goods or service it provides, including information about the entity rates, regulated activities, the rate setting process, the identity of the regulated rates, and the impact of the risk and uncertainty on the recovery of the reversal of regulatory deferral accounts. So the effect of the rates regulation on the entity financial statement, including the basis on which regulatory deferral account balances are recognized, how they are assessed for recovery, reconciliation of the carrying amounts at the beginning and end of the financial reporting. The effective dates. An entity elects to apply IFRS is effect for an entity first annual IFRS financial statement that are for a period beginning on or after January 2016. Thank you for coming to my channel. Please subscribe to my channel and I will see you in my next video. Thank you. Bye.